Bargain hunting, right? Yes, that was true. I had a lot of ideas for trades in the last few days. We haven't pursued any of them, so this would be a great time to do it, wouldn't it? All right, so let's move onwards and upwards. Should we work our way backwards? All right, well, let's start with today and then work our way back, and then start back on Monday. So this morning we talked about, in particular, what set me off was 9 Times Square is being put up for sale. It's interesting because immediately after that was announced, it was announced that the parent company, whose name I have now forgotten since it's like a couple of hours later, and that's how my brain works. Oh, American Strategic Investments, ASIC. So now we look for it, ASIC. Oh, it was a news item. Maybe I'm wrong. I'm not wrong. That's not the kind of thing I'm wrong about. Oh no, it was apartment income. It wasn't ASIC. No, AIRC. Damn it. Okay, I was wrong. See that? Anyway, so I thought they put themselves up for sale like right after they did that. These guys own a lot of properties in the New York area, and one of them is this building, 9 Times Square. It's a 100-year-old building, but you know, if you look inside the offices, they're all modernized and everything. It's not like it's all crap or anything like that. They've been constantly rebuilt whenever a new tenant comes in. You know, when you're paying all this money for the square footage, you tend to make the office nice. So these are all modern and nice inside. It just has a brick outside. It's right in Times Square. There's a subway stop right here on the corner of the building. I mean, couldn't possibly be a better location for being Midtown Manhattan and all that. It's 162,000 feet. It's 20 stories tall. Look at this thing. What does that say? Shokara. I don't even know what that is. Shokara? I don't know what that thing is. Anyway, so it's right next to, like, there's a Broadway theater here, and it's, you know, so I mean, it's right there. It's right where you want to be on Broadway. The main part of Times Square is actually in that way. So this is about a block in, but it's a nice corner building. It's a great location. You have subway access. There's no reason this building shouldn't be as full as it possibly could be, but they can't do it. You know, so they are giving up and selling it. They bought it for $160 something million, and now they're selling it for $60 million. That's really awful. And you know, $60 million. So think about that. And they don't have a buyer. They are just trying to find a buyer for $60 million. The bank has extended their rollover on the building because it's rolling over at a higher rate, and they're gonna lose it in a bankruptcy. They've got to dump this thing. That's what they're being forced to do. But that's going to start happening all over the city, because the only reason we haven't had a crisis yet, and I don't mean just New York City, I mean the entire country and the world. The only reason we haven't had a crisis yet, and I've been saying this for quite a long time, is that commercial leases are long term, and you don't really get hit with it until you roll over. When the lease rolls over, when the commercial mortgage rolls over, and also for the leases for your tenants, the tenants are rolling their leases over saying, hey, we're not paying this money anymore. We're not going to pay you $75, $80, $100 a foot to be in your building, because I can move, you know, I can move to this building or this building or this building or this building that are half occupied, and they're going to give me incentives. I won't even have to pay rent the first year to get into these places. So it's well worth it for these offices to relocate to another location or whatever. So they negotiate really hard. These guys can't raise the rents. They have to lower the rents, basically. Not only that, the worst part is these companies are the companies that are there are only half occupied. So the space that they're leasing is half empty because of all the people who commute now, who work from home. And so when they're renewing their lease, it's not just that they want a lower rate per foot. They're saying, oh, and by the way, we don't need half of our square footage. We're gonna, we only want to renew on this part of on half the office. And now these guys have to scramble and find somebody else who also refuses to pay these prices. So, when you've got 160,000 feet, right? Let's see if we can find a calculator. So it's oh, I'm sorry. So it's $60 million. Well, let's work this out. Ooh, I want to see if Bodhi can figure this out. That'll be fun. Probably not. It's a lot of math. Okay, so we've got what was the number exactly? 63 million. All right, so let's say 64 million. They won't even get it though. But whatever. So, well, let's say somebody buys it for $60 million. Wait, that's $60,387,000 a month. Okay, and it won't be 30 years, so it'll be 15 because it's commercial. So 531,000 a month, 6 million a year. That's how much they need to cover. So they have how many square feet? So it's 6 million a year. And 162,000. Well, there you go. So it's $6 million divided by 162,123. So that's $37 a square foot, not including whatever they have to pay in taxes, and not including whatever they have to pay for maintenance and so on and so forth on the building and heating it and whatever, and however they negotiate all that crap out, right? So $37 a foot. So, yeah. This will be fun. I'm just curious if he can do it. This is the baby Bodhi actually. So he's a spin-off of Bodhi. 9 times square in NYC is being sold. And here's some details. Can you figure out what the per square foot income needs to be for the buyer for the buyer, damn it, for the buyer to make money, and don't forget to estimate taxes, maintenance. Oops. What the hell is that? Don't forget to estimate taxes, maintenance, etc. It'd be funny if he figures it out. Oh, I'm sorry, it's not 37, it's 37 times 12, because it's an annual square footage. See if he figures that out. But it is 37 a month. $244 per foot maintenance. It's good that he shows his work while he's doing it. Whoa. Whoop. Anyway, all right, well, while he's here, it's a lot of thinking apparently. So, oh, here he goes. Taxes, 6 million, that's a bitch. It's 10% of what you pay every year. Oh, insurance, that's a good one. Insurance is $5. Holy shit. The buyer can't expect full occupancy. We'll see, he's really on top of this. Assuming a 90% occupancy rate, you're not going to get that. So he's saying 80, he's saying $80 a foot per year. Someone who knows what they're doing has to go and check that. And he's saying they can get away with $80 a year. Therefore, to make a 6% return, the average rent's of 60. And obviously, if you assume you're more like 60% occupied or 70% occupied, you're going to be having to bump that up by whatever that is below 90. So let's say 20%. So you have to add $16. You basically have to do $100 a foot, assuming his math is right. I was getting a higher number. But anyway, so the point being that these guys are screwed. You know, it's such an incredibly large amount of money that they have to ask for these buildings, and that's after selling it at like 1/3 of what they bought it for. So, so everyone's going to be in this position. I mean, all these people with these trillions of dollars worth of properties that aren't worth trillions of dollars anymore. That's the thing. I mean, there's an unrealized loss that will be ultimately borne by the banks. And you saw what $100 million did to NYCB and people like that. It doesn't take much to really topple these bank balance sheets. And in fact, later today, we're going to get the Fed's doing a balance sheet test on the banks, and we're going to get the results of that. And apparently, there's 4 or 5 banks that have already been warned, major banks that have been warned that they don't have adequate rescue plans for their balance sheets. They were supposed to have a worst case scenario plan, and the Fed has already told people like Citibank that like, no, you need much more reserve than that. And when you look at these numbers, you say, well, absolutely, this is going to be a total disaster. All right, so commercial property price index. It's been since 2022, since the massive stimulus ran out, which kept everything open. In other words, we were paying people, we were paying companies not to fire people and not to lay people off during COVID, even though they really had nothing to do. So we had all this money was being handed out by the government, was being put into commercial real estate and stuff on the premise that the government would support everything, but they can't support it forever. And when that support ran out, everything started running downhill pretty fast and pretty consistently. Malls, which were clearly during COVID a complete disaster, had already bottomed out nicely. I mean, at horrific levels, minus 40%. So I like malls as an investment. We like Simon Property Group here is a good one. That's my favorite. Offices, as you can see, seem to be, they haven't really bottomed out yet. See, minus 40%. That's exactly. I'm sorry. It's minus 60% for the building we're talking about. So they haven't realized their bottoms yet, because the math just doesn't work on that kind of stuff. Then you got healthcare. You have strip malls, which have held up relatively well by comparison. Hotels are kind of making a comeback. Apartments are coming back, and I don't understand. I don't understand how they sell off like this, because frankly, rents have been going up and up and up. So I'm not sure why apartment people can't make money, but I imagine the insurance is part of it, and the cost of maintaining the buildings has gone up tremendously. Look at self-storage units, and I don't see that one either. As far as I understand, there's more and more people putting things in self-storage because they can't afford big apartments, and they're putting it in self-storage. But maybe people are just throwing stuff out at this point because they can't afford the self-storage either. I know self-storage thing I had when I left New Jersey, it went up and up and up. It went up two and a half times in a couple of years. And I'm like, oh, that's how you make your money. You bring people in, and they just keep jacking up their rents. I know what a man home is, frankly. Manufactured home. Okay, so manufactured homes and industrial spaces. I mean, look, everything is terrible, basically. That's the bottom line. Everything is falling apart. And as these ultra low rates that we had for many, many years roll over, they get worse and worse. There's no profitability to the building. Meanwhile, we have a housing shortage. So what we have to start doing is converting these commercial spaces into residential. But that's not easy because it's simply not designed that way. I mean, if you think about an office that you live in, there's one bathroom. There's one bathroom on a floor. And you don't want to, if you're going to make apartments, you need more, but you either need more bathrooms or you need to get people to embrace the lifestyle of dorm living, where you're sharing a shower area with a whole bunch of people and a kitchen area with a whole bunch of people. That probably is going to be a tough sell. I mean, especially when you're still into these incredible prices. I mean, like you saw, it's 160,000 square feet, right? So you got 160,000 square feet. 160, 123. Well, so if you break it down into 1,500-foot apartments, it's only 106 apartments. How are you going to make your money? What do we say they need? $6 million. So $6 million divided by 106 apartments, 106, 15,000. They need 56,000. So they need basically $5,000 a month with a totally full building to rent out if they want to turn that into apartments. So even buying the building for $60 million, you'd have to then do the conversion, which would be another, oh God, probably 20 million to do the conversion, and at least 10, so let's say 15 million to do the conversion. So now you're into 75 million. That's going to bump you up 20%. So now you need, let's say 7 point, and we didn't do the fees and the taxes. So let's say you need, well, it's not going to work, is it? I mean, you can't do it. How are you going to $8 million a year to run the building and make a profit divided by what do we say they were? 1,500-foot apartments? I guess you don't, that's why you don't get a 1,500-foot apartment. Well, that's actually true, but on the other hand, let's say 1,200 feet apartments. Oh, that's apples and oranges, isn't it? 160, 5,000 feet divided by, whoa, divided by 12,000 feet, 1,200 feet, 137 apartments. So we're going to say we need $8 million divided by 137. That's the same money. Then you still need 5,000 a month from everybody. Wow. So 5,000 a month. If you converted that building into apartments, you would need $5,000 a month from each tenant. It's not doable. See, and this is where you say, this is where you see everything's going to fall apart, right? The math doesn't work. That's ultimately the economic reality of things. The math doesn't work. It doesn't work as office space. It doesn't work as a residential space. You can't make the building work, even at the discounted price of $63 million. You can't make the numbers work for to make a profit on the building. So who's going to buy it? There's no point. It's a 100-year-old building. It's not new. You know, I mean, in most other cities in the world and most other places, you can build a brand new building from scratch for that kind of money and have it exactly the way you want it. That's a lot of freaking money for what? That's why, therefore the numbers do not work. Therefore, this market will collapse. So these guys and their bank are saying, okay, well, we're gonna get rid of this building in the next 6 months for that price. No, you're not. It's not gonna work. And if it's true for them, it's true for the next guy and the next guy and the next guy. And that means that this entire market is still overpriced by a very wide margin. You don't need a little collapse. You need a big collapse. You need bankruptcy sales. You need the building owner to go bankrupt. You need the bank to absorb it. And the bank will then say, we're going to take a loss, and the government will bail them out. So for 60 million, the bank will sell the building for 30 million, and the government will step in with 30 million, and then the government will probably bail them out for 30 million. And then somebody will buy the building for $30 million and put $10 million into renovation, restoration, and whatever, conversion. And then they can rent out apartments that are 1,200 feet for $3,000 a month or something like that. That would work. But to get to that kind of beneficial recovering cycle, you have to first go through pain. And the problem is the Fed and the government, and this has been going on all since COVID, right? They never allowed the pain to happen. Instead of spending the money to bail out the banks after the whole thing collapses and the prices adjust, what the government has done is wrong, very, very wrong way to go about it. The stimulus prevents the collapse. Not only prevented it, but actually made things go higher. Here's COVID. Everything should have collapsed. But instead, we allowed these things to go high, especially industrial manufacturing. We encouraged the jobs and kept the buildings open and so on and so forth. And this is self-storage went crazy, right? But anyway, we allowed these things to go higher. So the stimulus money, rather than the stimulus money should be applied here after the collapse. But instead, we prevented the collapse. And now we're out of stimulus money and everything's falling apart. And the government's still going to have to come in and bail out the banks later. But we should have gone through that cycle when everything collapses. This is in the Great Depression too. We have this. When everything collapses and you're buying, somebody's coming in and buying land for 10 cents on the dollar. And you can say what you want about that, whether the land barons and whoever come in. But it doesn't matter. The point is, though, that you can economically, as we just did the math, you can economically recycle the building, recycle the land, so that even the people who were devastated by the catastrophe, at least coming out the other end, they will be able to get cheaper housing. But we have prevented that from happening in this cycle, and that's the disaster. That's what we're trying to work our way out of. Then we talked about some of these companies that are being affected. Now, I don't honestly, SLG is a very big property owner in the city. I talked about them a bit down here. SLF, wait, oh no, I got the wrong chart. I'm so stupid. I hit the wrong letter. SLF. No, SLG. Oh no, SLG is correct. SLF is incorrect. So here's SLG, but if you look on SLG, if we find, let's say Stockopedia, SLG. Oh, I talked about this in the post. They don't make any money. They've been getting smaller and smaller every year. They've been losing and losing money. And they're going to lose, they lost $500 million because they wrote off properties and wrote down their assets, right? They lost $500 million in last year. So God knows what their debt is. They owe $3.6 billion, $3.3 billion in debt. They owe $3.3 billion in debt. They've got a market cap of $3.6 billion. They make no frickin' money. So if you pay $3.6 billion for this company, you're assuming $3.6 billion in debt, and you are losing $100 million a year. That's what you're getting for your $3.6 billion. Hence, nobody's buying them. I don't know who's buying their stock. That's crazy. At even if they hit 100 million, that's still 36 times earnings. Even if they're at 100, I'm sorry, not 100. They're losing 100 million. They have to turn around and make 100 million to get to 36 times earnings. It's infinity times earnings now. So this is just an insane stock. I don't see why anybody's in it. And again, this is the pending crisis. People don't realize how bad these things are. This is a total disaster waiting to happen. So SLG was correct. Sorry, this is, for whatever reason, it says SLF down here. I think that's just me making a typo. I'm pretty sure everything else is right. Yeah, SL, see, I'm talking about SL Green, of course. Anyway, so we have other stocks that they're going to be in trouble. Vornado is also a big holder of properties. Boston Properties is another one. Then you got these side issues. So anyway, you can read all that. This guy had a nice overall take on the real estate market and how it collapsed and all that and what's going on. So I like that a lot. Anyway, so that was that. That's what we talked about today. And what did we talk about afterwards? We talked about nope, just a lot of it. Oh, and then we talked about the yen collapsing. That's a big deal too. So we have commercial real estate collapsing, and we have the yen collapsing. Hang on, a lot. Raining a bit too much. So it's a weird sort of market. When you look at commercial real estate collapsing, what does that do? That squeezes money out of that sector. Nobody's putting money into buying these buildings. Usually there's a lot more buildings being bought. Since that nobody's buying buildings, that investment money has to go somewhere. And it ends up squeezing into the market, okay? The yen is collapsing. That's a big currency. Usually a lot of money goes into the yen. Nobody's putting money into the yen. Where's it got to go? And then you have to look at what are your alternative investments. So commodities, China's slowing down and has a lot of problems, so therefore commodities are not being a good bet. Where does the money go? It goes into equities. It's got to go into either treasuries, which is a joke. It's got to go into housing in the like U.S. housing and commercial properties, also not a good place to put your money. And actually, I'm sorry, residential real estate is a decent place to put the money, except the problem is, again, we never let it collapse, and therefore we just keep building expensive homes that nobody can afford. So how are you going to put the people who need homes? We have about a 6 million home shortage now. How do you put the people who need 6 million homes into the homes if they can't afford them? So either the home prices have to collapse. So therefore, obviously, the builders are hesitant to build. Therefore, we continue to have a housing crisis because the cost of building the home and it doesn't match with the amount of money people can afford to pay for a home. There's no profit. Math is the ultimate arbitrator of market tops and bottoms. Eventually, you have to do the math. So either we have to allow housing to collapse, which would again cause a banking crisis, so that's not really a great solution, or we're going to have to start paying the workers enough money to afford the homes and get a cycle going where they can start getting loans. Or, well, the next or is bad though, or the government can step in and do an Affordable Housing Act kind of thing and put people into homes, but then that will then keep, it's another stimulus package that pushes up the price of housing. It's all tough to balance. I think the best thing to do is to create incentives for low-priced homes. Before COVID, the average or the median price of a U.S. home was $250,000. It is now $450,000. That's how much it's gone up in the last 5 years. So and at the same time, the mortgage rate has gone from 3% to 6%. So that's doubled. So the interest you pay on the home is doubled. And oh, is there a mortgage? Mortgage. And here's something you need to know. Very, very important thing. Mortgage and more. Amortization calculator. Bank rate calculator. I'm just looking for one that's probably not going to be too annoying. Because pretty much anytime you go to a mortgage calculator, they're basically trying to sell you something. So here you go. So home purchase price, $450,000. Okay, down payment. Let's say you put 20% down, $90,000, and good luck finding that, right? So your loan amount is, really? You can't do the math? This is shit. 320. How do you get these numbers? It's 360,000. Right? 90, 450, correct. Okay. So then your loan term, 30 years, your APR is 7%, your payment is monthly, and we say calculate it. And it's not going to do it. And oh, maybe it did. Oh, haha. Okay. So principal 7%, term monthly, blah blah blah. So your payment amount is $2,300 a month. And here's your schedule. Now here's the funny thing though, you got to realize. So when you take out the loan for $360,000, after 30 years, oh, what is this shit? Oh, it doesn't show you the totals. Ugh. Balance, interest. Does it not total your interest? Anyway, after 30 years, you'll pay like $500,000 of interest. That's the killer part of it. So it makes a huge difference whether your interest rate is 3% or 5% or 7%. That's the most important number in the thing, not the price of the home. But the rate, this is a shit calculator, really? Loan schedule. Oh well. That's a shame. Oh, the government. Maybe they can tell us. Always trust the government, right? Ooh, look how interesting that look is. Loan amount. So it was 360. Monthly payment. What? Term in months. Okay, 360 months. Don't pay 9%. Oh, this is very dynamic. What are you? Whoa, whoa, whoa. But you're not telling me anything useful either. View report. Oh, there you go. Ha ha. Damn, I hit it on the head. 502,000. Wow, I'm good. So there you go. So at 7%, you're paying $502,000 of interest on your loan on a $360,000 loan. That's what kills you. It's that freaking interest is just diabolical. You're paying and you're paying and paying. But then the big deal also is that property taxes are up, insurance is up, everything else is up. It makes it very ugly. Brendan's asking if I think WTI is a good short. Wow. You're gonna have to ask me in chat because I'm gonna have to look it up. I haven't looked at these guys in forever. They've got they had this one-time bump in business which I would ignore. So if you look at consistency wise, they've gone 581, 530 thing, whatever that is, I would drop that 558. So this seems to be about their revenues. It ain't gonna change much. Can they make money? They used to make money, then COVID, they lost some money. That, like I said, something weird happened here. They probably sold an asset and made a profit. Now they're losing 20, but they're going to lose more next year. Yeah, they're spiraling. The debt's not bad. The debt's only a couple hundred million, but it's a small stock. It's only a $300 million stock. So it's a $300 million stock losing 10% of their value every year. I don't, we have to look at them, but I don't see any reason. You have to find out what their acquisitions are, what their strategies, what they've been doing. But you can see over here, it's not looking good, right? I mean, they had this bump up that was almost certainly something weird happened there. But generally, they're just trending down, down, and not good. And the P is getting higher. So yeah, on the whole, it probably makes a good short. You remind me in chat now, and we can talk about it. I'm not a big shorter of stocks, although we may have to be defensive. But also, they've sold off a lot. This is a $2 stock now. They may be on their way to zero, but it's hard for me to get behind shorting something. It's just a tricky way to make money, especially when we've been hit with all these different rounds of bailouts and such. It makes the short side investing very hard. And oil, of course, is crazy. You never know what's going to happen. But I can see that even if the price of oil goes up, is it going to help these guys? Do they have enough projects that are on their books that are working? Or will that then make things out of reach? Like, because you can get screwed because you sell off your assets and you say, oh, and now we're going to go and buy some more stuff, but then the stuff you have to start chasing the stuff as it goes higher and higher. So oil right now being 80 something dollars, you may be chasing the highs when you go to try to buy new projects, and they could put them in an even worse position down the road. All right, anyway, moving on. What did we talk about earlier in the week? Now let's do some digging. I'll look at Phil's posts. We did a special report for the premium members of the new trends and what to buy there. But let's just start with Monday, because we have plenty besides that to look at. Because I've been picking out things for the last couple of weeks. Oh, Monday I was talking about the yen. It's funny. It's getting worse and worse. Speaking of intervention, right? Much intervention there. Tomorrow there's a lot of data. Tomorrow we've got durable goods, GDP, jobless claims, corporate profits, that comes in with the GDP anyway, retail inventories, and pending home sales. And we're having these auctions. So we had the 5-year auction already went off today. I don't know how well it went. Rivian, they're talking on CNBC, doing a lot better than we expected. And they're boosted because they jumped 21% today. Holy shit. So their loss was nowhere near as bad as people thought it was going to be. Buffett's been dumping Boyd, so they're probably at a dead end. Huh. All right, so he can't find it. It only just happened. He doesn't find it. Oops. All right, I'm not worried about it. Anyway, and there's more auctions. The 7-year tomorrow also, that one matters also. Let's see how Google does about this thing. How often? Treasury 2 auction. We know that. Fine. Results. There you go. Five-year reopening, no. Oh, I see. That's why Bodie couldn't find the results. Huh. Okay, so I can't find them either. All right, so we talked about the yen. This is Monday's chat. Oh yeah, here we go. I knew they were there. All right, so I had Warren go over the whole month of June. That's why Monday's good to look at. We went over the whole month of June and looked at things that were good trades. So HPE, we picked that already as a trade. Paramount, we looked at Paramount, and it was going good until Sherry, who owns a majority shareholder, decided that she wasn't going to sell. And so the question is now, will anybody touch them now? Well, let's look at 3 months, or 1 month for that matter. There's 1 month on Paramount. So earlier in the month, we had liked them when they hit $10 because we thought that would be a good price. They did get an offer, and the price went up to oh, they only went to 11 there. Wait, where are we in the month? Oh, here's May. So anyway, here there was some buying interest, but then she killed the deal, and now the question is anybody going to come back to have an interest in the company when you know that the principal shareholder at the last minute is going to go, no, I don't want to sell it. I changed my mind. How is somebody going to bother taking the time and effort to go through the books and sit down and negotiate? There's a cost to doing all that. So it's going to take somebody like, Disney, who specifically reaches out to her first and says, we want to buy this, but then Disney has to worry about antitrust stuff because Disney is ABC. It's hard for ABC to buy CBS. In fact, it probably won't be allowed. But if somebody like that who can convince her to sell to them, and somebody who she would want to be involved with, if somebody like that can't come in, what are the chances some group that she doesn't know is going to come in and do it? So this could be a dead stock only because it's unsellable. It's unsellable and it's profitable. $56 billion market cap. They're going to make $1 billion. That's not a particularly good PE ratio. Not 56. Oh, I'm sorry, not 56. I'm just thinking that's insane. No, 7 billion, like 6.7 billion in market cap. They're going to make almost $1 billion. It's actually a nice profitable way to put your money into something, but it's locked, and that's the problem. See, if you put your money into a stock and the money's locked up, oh, they do have a shitload of debt, 12 billion in debt. So let's say you applied a normal ratio to this. Let's say you had $1 billion in earnings, and you said, okay, we're willing to pay 15x. So you're willing to pay $15 billion for the company, okay? So the shareholders currently have 7 billion, and it cost 12 billion to pay off the debt. That's 19 billion. So effectively, even if somebody comes to you with a pretty good multiple with even if somebody's willing to pay 15 times earnings for the company, that's still going to only be $10 a share for the shareholders because you're going to pay off the debt first. Or somebody has to be willing to assume the debt. That's why I'm saying Disney, because Disney could care less about 10 billion in debt. They would just look to monetize the assets, and the main asset that you'd want to monetize out of Paramount is Star Trek. What are the most valuable Paramount PARA franchises? Star Trek and Transformers. The sum of the parts. That's a good one. I'm not a robot. Screw you. All right. So this guy's saying the studio real estate and its IP, and let's say that's 10 billion. IP is 7 billion. Land is 3 billion. CBS is 10 billion. He's giving this some crazy valuation. It's not realistic. Showtime, just to give you an idea of their assets. So Showtime, Nickelodeon, Comedy Central, MTV, Viacom assets. He's crazy here. All right, anyway, so you've got their studio itself, the production lots, and the overall properties that they own, and so on and so forth. That's probably a good chunk of California real estate. That's got some value, but not billions. So you're not going to get that far with that. The real value is, you have to say that Star Trek, not as valuable as Star Wars, but Star Wars got bought by Disney many years ago for $4 billion. So there's billions in that franchise. Transformers, let's say, also worth a couple of billion as a franchise. And then you've got all the other shows and so on, properties, and the networks. You got to say Comedy Central is worth some money. MTV certainly worth some money. Showtime's worth some money. And also Paramount has a massive, massive film library that's under the IP. All that's under IP. So you can see we can get to $7 billion there. He's saying $3 billion worth of land, and the studio itself has the value. So I still find it interesting but dangerous. So let's put it in that category. GoPro with a subscriber model, I still think they're going to turn that around. It's tough. They're not showing much sign of it. I'll tell you that much. GoPro, let's see. They're just going down and down and down. They are rejiggering the company. The sales are still there, and don't forget, you got recurring revenues from subscriptions that they have. So sales is still there. The profit is not, but part of that is because of themselves reinvesting in it. They have shown that on 1.1 billion, they can make 371 million. On 1 billion, they made 28 million. Then they lost some money, but they spent it. They still have money. They still have that's TTM, right? They still have $150 million net of debt. That's very key. They're only valued at $200 million at this price. It's a crazy low price for a company that theoretically should be able to generate $50 million. So they purposely spent this money and took down their cash position from $300 million down to 150. They spent the 150 million on purpose, retooling themselves to reinvent the company. But will they be successful? They could blow it. So interesting, but not necessarily bulletproof. Nokia. Oh, Nokia is a real bargain. Nokia, $20 billion. It's a pretty solid company. They've got $20 billion in revenue. They make $2 billion, so they're being valued at 10 times earnings. They again, in COVID, they got smacked. People took write-downs. So it was a good time to take write-downs and have excuses, and then you don't have to pay taxes going forward and so on. But you see what happened. They took these write-downs, then 1.6 billion, 4.2 billion, so 225. These, figure these evened out. Then 2 billion, 2 billion. So they should be back to dropping 10% to the bottom line. There's no reason to think they'll take a substantial hit to their business. They mostly are a service provider. They've got $3 billion in cash. So 15% of their valuation is cash, and they're only trading at 10 times earnings. So this is definitely an action item. So in fact, where is my thing? Should make some notes, right? Wouldn't it be great if I had something to actually write things on, like a piece of paper and a pencil? Okay, so here you go. So now we figured out Nokia. All right, so actionable trades. NOK. There you go. Here's a good place to write it. What's the next section? So Nokia, Walgreens. All right, well, let's just keep going through them. Why not? It doesn't take that long, does it? Do I want to keep going back and forth? Or do I want to open a new page? Nope. How do I get to my... So now I'm going to end up doing what I want to do in the first place. That won't open. Got to just open a new PhilStockWorld incident comment link. New tab. There you go. And it's going to go right to that comment. Okay. Okay, now I'll use that, and I can always click over. All right, Walgreens. We already have a lot of Walgreens because I've been wrong and it keeps going down. But you know, see, when you're a value investor, and you could be wrong about the value, but when you're a value investor, this doesn't really matter. It doesn't matter what other people think something is worth. It matters what you think it's worth. So what I think with Walgreens is for $13.5 billion, 120 billion, 130 billion, 140 billion, 150 billion in sales. Sales are going up and up and up. Profits, they used to drop 5, 4, again, COVID. Nobody could go to the store, except it's weird to me with drugs, because I figure people still gotta get their drugs somehow. 2, 4, and 3. So they used to make 30%. Not 30%. 10% would be 3%. Sorry, they used to put 3% to the bottom line. Now they're putting 2% to the bottom line. But they should be able to maintain 2%. 2% is $2.7 billion a year on a $13.4 billion valuation. So as it says, that's about 5 times earnings, which is ridiculous. 5 times earnings is 20% back on your money. You give them money, they make 20% of it back. And they have spent money on things. Some projects worked, some projects didn't work, whatever. One of the biggest problems Walgreens had, and CVS had this too, they were both racing, before COVID, they were both racing to have in-store medical clinics. And unfortunately, they were building them just when nobody was showing up at the store. And that whole thing sort of blew up in their faces. So that's been a big problem for these guys. Debt-wise, they have $10 billion, $9 billion in debt. This working capital number is disturbing. You should never be read. So they don't have working capital. Let's put it that way. They have a serious working capital deficit. That's a problem. It doesn't change the fact that they only have $9 billion in debt, but the problem is they don't have any cash reserves. They basically have pure debt. So in other words, they have all debt, no cash. They are running really day to day. This is a big problem. I mean, you know, that can make you nervous, except you say, except, all right, here's the thing, another COVID would kill them, which is true of a lot of companies in America, but another COVID would really kill them. That drained out their cash reserves and put them in a pretty bad situation. But there's a lot of competition. Online pharmacies, Amazon's trying to get into the game, Walmart's in the game, every single freaking grocery store is now a pharmacist. So they've become grocery stores. The Walgreens and CVS's have now become grocery stores to sort of fend that off. But that doesn't work because they don't have the square footage to be a grocery store. They basically are snack stores, and they're cosmetics, but they're not the cosmetics that, like, people buy. Now, it's weird to me because Boots, WBA is Walgreens Boots Alliance. Boots in Europe is a place everybody goes for cosmetics because they have a much higher end lineup. They've always been the go-to place for cosmetics. And yeah, there's fancier places and whatever, but for normal people getting normal everyday cosmetics, they always go to Boots because it's a great run place with nice stuff. I thought they were going to take Boots and turn and do that with Walgreens and turn it upscale. Instead, they take Walgreens and run Boots downscale. I don't understand what they were thinking. I really don't. But nonetheless, this is a cash throwing business. I don't think they screwed it up to the point where it's not recoverable. You just want to keep an eye on the numbers and see if they're actually heading towards these goals. But if they're going from 140 last year to 150, and their profits are hovering close to $3 billion, then $13.5 billion is a stupidly low price, and I still like them. And that's what I say about that. So I guess I have to put WBA is still a contender. Crazy. Sorry, Yodi. He does not like them at all. Then where were we? Okay. And what did we decide about GoPro? Too dangerous, right? SoFi. SoFi is not a bank. Well, they are a bank, actually. They got the bank charter, and that's why I do like them. But they're not a real bank. They're digital. But they have a bank charter. That's what's important. So they're able to do bank stuff. And more importantly, they're able to borrow like a bank. So they should be their first profitable year. And we're paying $7 billion for them. They're going to make 100 million this year. They're going to make hopefully closer to 300 million next year. And that starts making sense from a PE perspective. But the growth, the thing about SoFi that I like is that the sector they're in, obviously, and what they're doing, these guys could easily pull in $1 billion a year. They can easily grow to that number, in which case their current valuation is a joke. So as a long-term play, I love SoFi, and that's what we've been doing. We're just sticking to it and adding to our position. And when they're down like this, which is what, 639, I think they're screaming buy down here. So we will add them to the list. See, and that's what we do. We just run through all the possible things that seem interesting. Vail is our trade of the year. I'm not even gonna go over that. Vail is too cheap. They're just being slow, but they're there. Disappointing start, but potential upside once settlement. Brazil is finally right. They have this, mining disaster thing with Brazil that they have to, a dam disaster actually broke, and they have to get that finished. They're not the only culprit there, so there's a couple of people involved. And once the settlement finalizes and the stock looks good, it should start ticking up. Okay. Now, next set. Disney. Well, it's irrelevant what the market cap is. Disney is Disney, right? This is a huge freaking company. They're trading at 20 times earnings now. It's not that cheap, but I also don't believe that they're likely to lose $100. It's just I think they're going to be able to trade in that range without any more COVID coming in. Now, the problem with Disney is if COVID comes back and it's not gone, and then there's the bird flu behind it and everything else, they could have another disaster. But the thing is, and again, if your attitude with Disney has to be that, okay, well, they'll have another disaster, but then it'll be over, and Disney is still Disney. It's going to be Disney. It's not likely that 100 years from now your kids won't have Disney pajamas. They got a really, really solid thing. Now, what else do they have? They have cruise lines. They have hotels. They kind of dial back their retail presence, frankly. So big on the cruise lines, big on the hotels. They make ungodly amounts of money. They make $9 billion a year. They're going to make $10 billion next year. They have 32 billion debt. Oh, I'm sorry. They also own ABC, of course. They own ABC and ESPN. And they've gone through a painful period of fixing it. You know, this is they've done a lot of work with ESPN. They turned it around. Revenues are coming back in. It's a solid company for long-term investment. So yes, we can definitely make money out of them. I think we already have them in the butterfly portfolio, but oh, here's another one where they've run out of the working capital, ran down, huh? So definitely a good one for the butterfly portfolio, but I'm pretty sure we already have it there. And by the way, and there are trades. So if you go to Monday's thing, there are trade ideas right here. It's like we've already done these during the month. But you see, that's the point. Like, just because other things have run up like crazy, you don't have to chase that stuff. There's perfectly good companies we can buy for good prices. Intel, oh, what I'm not even going to get into that. Intel, what a mistake. They are coming out with a new line of chips. They will be supplying AI, just like NVIDIA, and they will make plenty of money. These things cycle back and forth, and someone takes the lead and someone's behind. And obviously, Intel's been miles behind lately, but they'll start catching up and become a money machine like you wouldn't believe. And even where they are now, and this is what's insane when you look at where they're down to. $130 billion, flat as a pancake, down about $30, right? This year, 4.5, but this isn't like a fantasy camp. Look at 52, 62. 2026 is going to be skyrocketing because then you're into the AI stuff. But they already know that they're going from 4.5 to 8 because now they're spending money finishing up the foundries that are going to start cranking out these AI chips and all the advanced PC chips and everything else. And they've got pre-orders for these things. They're like Boeing. They've got orders for the next 5 years of everything they can possibly produce. So these aren't fantasy land numbers. This is what they're going to make. And they've only got 24 billion in debt. That's easy to service when you're making 8 billion. They look what they used to make. See, when their chip production ramps up and they're steadily supplying chips and they don't have to invent new chips, that's what they look like. But then the chips run their course and they have to start building the next generation of chips, and that takes them 4 or 5 years. And COVID made it worse. Usually, I think it's a 3-year turnaround, but it took them about 4 years. And now year 5, they start making it, and then you're going to see this number again, $20 billion, and the market cap is 130. This number is going to go from 20 to 7. It won't go to 7 because they won't be at 130, but you'll have it at 7, so you don't care. So absolutely, I mean, not even a question. Oh, I already did it. I'm like, absolutely, and it's already there. Cisco, oh, another one. I can tell you right now, there's no sense in looking, but we'll look just for fun. Cisco. And how do all these things connect? Whether it's NVIDIA or Intel or AMD or whatever, how are you going to have these devices talk to each other? How is your delivery bug? Oh, in San Francisco today, Google, who owns Waymo, officially is picking up people. They just blew past Elon Musk and all his bullshit, and Google today got permission from the city. They've run a year, 2 years of testing. They've proven that the no driver is safer than having a driver, that it's actually that their cars outperform drivers. And they're willing to take the risk because they're big enough to be able to afford to take the risk of lawsuits and whatever that happens. But in the city of San Francisco, right now, you can go on the app and click Waymo, and a driverless car comes and picks you up. That's happening right now today. They just put it live. Everybody in San Francisco can download the app and get driven around by a driverless taxi. And we've talked about Lyft and Uber and whoever employing fleets of driverless taxi, but now I got to start rethinking Google, because the problem is they don't need those guys. Google doesn't need Lyft and Uber. Google doesn't need to license their technology. And it's interesting because who's got the money, right? Google can buy and sell both of those companies. So they don't need to partner with Lyft just because they have a little bit of an advantage. That advantage won't last very long when Google can field a fleet of cars with no cost of driver. Don't forget, the driver gets almost 2/3 of the money in these transactions. You know, the drivers complain that they only get like the car company gets 30% of the money, right? When the drivers are all complaining how they give up about 1/3 of what they make to Lyft and Uber, right? Well, now Google's coming along saying, well, we'll just take 100%. We don't need you. You're not part of the equation. So we'll keep an eye on that, because if this goes, you have to look at the numbers from that perspective. And if you think about what's going on here, so here's Lyft, 4 or 5 billion in revenue, right? But that's their cut. So there's $15 billion of total revenue, and that's what they take for their end. Because they're not paying the drivers back. That's their cut from the transaction. And then you've got Uber. And so how big is Lyft? Lyft is a $5 billion company. Let's keep that in mind. $5 billion company with working capital, no debt. And Uber trading at 16 times earnings, by the way. So Lyft is not a bad company. But the problem is, see, the original premise for both of these companies, look at Uber though, 48, but Uber is way, way bigger than Lyft, $43 billion. That means they're taking in $150 billion of revenue and keeping 50 billion of it and giving the drivers back whatever. And they're making a decent profit, a couple of $1 billion, and they're being valued at 149 billion. So they're being valued pretty high. But why are they being valued pretty high? Because the premise is that they're going to flip that and they're going to make 15 billion a year once they get rid of the drivers. And that was a good premise for Uber drivers, except for the problem is, who came up with the technology? It's not Elon Musk. And Uber is going to partner with them, with Tesla, and have these cars and so on and so forth. No, it's Waymo and Google, who've got their own money and don't need Uber. And okay, I'm sorry. And so 2 billion here, so 2 billion here, and $1 billion from Lyft, so $3 billion. Now we look at Google, or Alphabet. I'm old, I call them Google. So it's $2.7 trillion company, like crush. $100 billion in freaking profit. Could buy both Uber and Lyft, but why would they buy Uber? I would buy Lyft. If I were them, I would buy Lyft and incorporate the self-driving fleet through Lyft, because why would I buy Uber when Uber is so massively overpriced? Lyft is 16 times earnings and Uber is 60 times earnings. So Lyft has a presence, they've got a customer base, and all you have to do is field a fleet of cars at a price that Uber can't possibly match, and let everybody know you've got a much lower cost solution all across the country. Because they don't need to charge as much as Uber does, because there's no driver to take the cut. They could make as much money as Lyft is making now, which is 10% of the profits basically. They can make 10% of the revenues and profits and the revenues will be doubled too. So it'd be more like 20% of what they're making now. As they roll in the electric cars, and they could charge the lower price, there would be nothing to pay to the drivers. So at 1/3 the cost, basically, that Lyft cars charge now, Uber could make the same money Lyft is making now. That's the market power they have over Uber. So Google, and the problem for Uber is, what are they going to do? Google's got infinity money. They have infinity money. Uber can go to Ford. Uber can buy Ford. One thing, Ford's only, let's see, how much is Ford? So now we have to go back to thinking about owning Google. Oh, Ford, $48 billion. So yeah, so Google could buy Ford with 6 months worth of their earnings, and they could have Ford do nothing but produce their self-driving cars until they're done. They can take over their whole production line, or do, in other words, they can do whatever the hell they want. That's the thing. Uber, on the other hand, has to make all these deals with the companies that have the self-driving technology and the car companies, or they got to use Teslas or whatever. Google can just do whatever they want. They are 800-pound gorilla. So Uber's got other problems. Uber's being challenged in search by AI companies, and that whole marketplace is falling apart, and that's an issue too. And that's why I've stayed away from Google. But this self-driving car thing, if this goes well in San Francisco, Google can get super aggressive and push into that. They can push, so Google can get super aggressive in that, and they can also push heavily into AI and robotics, although Gemini is disastrously bad. As a huge power user of these sort of things, Gemini is essentially useless. And that's also kept me off of Google. Look at Ford with a 6 PE. Ooh. I don't know if that got mentioned, but Ford, Google. Okay, see what happens? One thing leads to another. Oh no, we did Cisco already. La 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 la. Okay, Mosaic. Ugh, I don't like Mosaic. Mosaic appears undervalued. Stock faces cyclical risk and competitive pressures. Current valuation provides an attractive entry point for value oriented. I think so. I think he's right, because Mosaic is a potash company, fertilizer essentially. And we're wrecking the environment, we're wrecking the soil. This kind of thing needs to be done. Did I add Ford? Yes. 11 times earnings is pretty strictly down. This is a very dull business, but look at it, it grows. Well, that was something happened there. Paid no attention to that, but it grows pretty steady. Actually, it's flattened, but it was growing pretty steadily. I have to look at a little bit more closely. Net debt 3 billion out of 9 billion. Nah, yeah. I see. I can't get behind it. I'm not going to write that one down. I don't like it. It's just not. I see the point, but I'm not sure I would want to do it. EURN, we already liked enough to put a trade up for it. Let's keep that up there. Busy on this day. NVIDIA. I'm sorry, I can't do that. I'm not. I'll tell you right now, I can't do that. Here's the thing about NVIDIA. Okay. They're selling the same chips that they sold here, because this was only a few months ago. Okay. So in January 2024, they were $50. Now they're $125, so that's up 150%. They didn't open up a new plant. They aren't selling more chips. They are selling the same chips for much more money. The chips went from 5,000, went from 3,000, but that was before this all started, before COVID. But they went from 3,000 to 5,000 to 8,000 to 20,000 to $50,000 for the same freaking chips. And yeah, they're modifying and making new versions and whatever. But the bottom line is they were the only people who had it. It's like buying NVIDIA and basing your premise on the fact that they're going to keep growing and keep selling these chips is like valuing a gas station in a hurricane that happens to have a lot of fresh water, and they have a lot of bottled water, and instead of charging $10 a case for bottled water, they're now charging $50 a case for bottled water. And you're like, well, that's great for them as long as the hurricane lasts and the disaster happens, but are you going to bet on that being their valuation for the next 5 years? No. Things will normalize, supply of water will come back, and everybody will have some, and they'll tell this guy to drop dead. Now, NVIDIA is still going to be a player because it's going to be a long, long time before this normalizes. Nobody saw this demand coming, and now the demand is tremendous. Tremendous. It's not just companies, it's countries that want these AI chips. And we haven't even gotten into the idea of an AI arms race yet, but look at the automobile sector. There's been a hack attack on the auto sector, and they took down a major, I don't even know, it's a computer system that runs a lot, that's been sold out by AutoNation to many computer dealerships to run their companies, and the whole system got hacked and is down and is being held for ransom. And as AI develops, this is going to happen more and more because the hacking is becoming intense. And you're going to have a lot of companies that are anti-hacking that have to use their own AI, and it's going to be crazy. And if you know the author William Gibson, who wrote a lot of really cool science fiction novels, if you read his stuff, William Gibson, like Neuromancer is one of them. The whole idea of the novels is that in the future, corporations will have to have their own AIs that guard the corporations, and the main value to a company is how well they are protected, is how well are they secure and protected, and you're allowed access to the internet in pipelines that are secure and protected by massive AIs that prevent hacking. Otherwise, you wouldn't even be able to use the web. Otherwise, you'd be hacked the second you'd sign in. So you have to then sign in through providers who have massive abilities, and everything, the whole world revolves around like hacking and defending against hacking and so on and so forth. Very interesting stuff. That's where we're heading. He was freaking right, and that was in the 80s. He saw this coming a mile away. Data security is going to be one of the most important things in the next 10 years. Because it's all useless if it's not secure. Your bank account is useless if it's not secure. Your data is useless if it's not secure. You know, you can turn. I mean, you understand this AutoNation, right? They're running this software program that they've leased out to thousands, tens of thousands of dealers across the country. I mean, most dealers in the country can't run their system. My brother runs a Mercedes dealership in Nashville. They can't function. Mercedes, because they bought the AutoNation system, and so did most auto dealers. So they're trying to do stuff by hand. The invoicing screwed up once it comes back online. So meanwhile, AutoNation wakes up in the morning and they go to work, and all of a sudden their system's off, and it's got that ha 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 sort of thing with a pirate symbol saying, okay, you're going to have to pay us this much money and to get control of your stuff back. Otherwise you can't function. And of course, their first thing to do is to say screw you, and they won't pay it and blah blah blah. But then they can't. Their programmers can't beat the other programmers, and they can't unlock it, and they can't figure it out, and they can't stop it. And the hackers continue to ask for more and more if they don't meet the demand, because now they can see that it's serious and they can't beat them. And then they decide to pay and whatever they're up to now, but apparently they'll be back online, but not until the 30th. So that has forced all the automakers, including Ford, so we're not going to rush into it, it's forced all the automakers to now have to tell the SEC we are going to miss our targets big time for Q2. They will not be able to book these sales and put things in and balance their books fast enough to show the Q2 sales. And not only that, it's actually hampering sales anyway. It was a catastrophe. And they're not talking about this, but when auto dealers report, we got to remember to wear our hard hats because it's going to be very ugly. And when the auto sales figures come in for the month of June, it's going to be very ugly. Where was I though? NVIDIA. Okay, so anyway, so demand, right? So there will be demand for all sorts of AIs, and it will be companies, not just AI companies, but companies are going to need to build their own AI systems to defend themselves. Like large corporations, especially Fortune 500 companies, are going to have multi-billion-dollar AI systems defending themselves. Not rely on outside people, because how can you if you don't know what the hell they're doing? You can still get hacked just because you can't rely on someone else to stop you from being hacked. You've got to have AI protecting your company systems and watching, like constantly watching for any suspicious activity all the time. And yet you can outsource this. Amazon provides that service, and Google provides that service, but can you trust it? No, apparently not. It's being proven right now with the auto dealers. You cannot trust a third-party company to watch your network. You have to have the ability, and that then will eventually lead to the collapse of most small companies. If they can't protect your data and you can't trust them, how can you use it? And think about that from a transactional basis too. And we've seen this all the time. TransUnion and various hacks of Visa, MasterCard, and travel places and whatever is in hotels. Marriott Hotel got hacked. You don't think a lot about it because it's only kind of random whether it affects you or not, but your data has been stolen 100 times, and the dark web is full of all these IDs and blah, blah, blah. And they haven't had the ability to sort through it and get to you. You're one of 11 million people whose account got hacked, and they haven't tried all the passwords for 11 million people yet. But you know what? AI is going to allow them to do that. So what's going to happen in the future? And I have this issue now. Like whenever possible, I don't even use my credit card. I use Apple Pay, because Apple Pay provides me with a layer of security. With your phone. I won't even take my card out of my wallet. I'll use my phone, and I click and I pay, and Apple Pay then tells American Express to authorize the card and so on and so forth. But the merchant never sees my credit card number. There's nothing about it on the system at all. So I'm already getting that paranoid, and I'm telling you that's what's going to happen. People are going to realize how vulnerable all their stuff is, and you're not going to give your card to some random merchant, somebody with a little shop, or somebody on a street corner, or whatever. And even New York City subway system now. Do you know New York City subway system now? You they work with Apple Pay though. In New York City subway, you put your phone on the thing, and that's how you go through the subway now. There's no more cards. There's no more nothing. So much madness in the world. But anyway, so NVIDIA, the bottom line is there will be massive, massive orders of AI, and it's going to continue forever, and it's a huge thing to invest in. So would I bet against NVIDIA? No, not really. But I also don't believe that they're going to maintain this position where they're selling chips. Look at this money. 120 billion in sales, 50% of it is profit. That's insane. They used to be 26 and 4. So it used to be 20% profit. Now they're 50% profit. That is not normal. That's more than 50% profit, by the way. So that's not normal. And then they project that we'll do even better. We'll do 160 and 9. And it's like, no, you won't. That's not going to happen. This is incorrect. And that's what's going to kill them. They're going to collapse big time. But then there'll be a super buy. Again, then I'll be sitting here telling you, well, just because they collapse doesn't, just because their profit collapsed doesn't mean they're a bad company. They still sell chips, just not at a freaking 100% profit margins. So that's it. So that's an interesting one. Where do we start from that? We started with NVIDIA. Yeah. And this is a trap most analysts, almost every analyst falls into. They just look at the numbers and they just extrapolate the numbers but they don't think about how those numbers are being generated and how unrealistic it is for that to continue. Apple, you can't, again, it's like, ooh, who was the other one that we just picked? Google. It's like Google. How can you bet against a company that makes $100 billion a year? They can go into any business they want tomorrow. They can start doing anything they want, anytime they want, and just decide to go off in a different direction. I'm telling you, Apple's going to be a robot company. They didn't get out of the car business because they didn't have any other ideas. They got out of the car business because they're getting into the robot business. You know, it's another one of those things where Elon Musk pretends he has something but doesn't. He pretended he had self-driving cars. Turned out Google has it, not Elon Musk. Elon Musk is pretending he has robots. Apple's the one that's going to announce an actual robot. They're just not going to tell you until it's ready. Apple's not going to announce a robot until it walks on stage and says hello to you. Step one, get AI. Invest massive amounts of money in AI and have a payoff. Once Apple has a robust AI system and they've got it linked to devices and they have the ecosystem for it to all function, then boom, robot. These things take time. So we'll keep Apple on the list, although not ideally priced at the moment. Whoa, what's going on here? Oh, keyboard. Oh no, where am I going to get these teeny tiny batteries? Wait, oh no, it's a charge keyboard. Oh God, what do I charge it with? I think that's smaller than my Apple port. Oh, that's annoying. Oh man. All right. I don't even know which one on is it. Oh, there it is. Okay, good. Uh-oh. Dead. Dead, dead, dead. Okay. Hang on. Let's see. Oh, not gonna be a USB thing. No, it's way smaller. I have no idea how to charge that. How about this thing? This one runs on batteries. Oh, but how is it gonna know? Nope. No, introducing a completely random keyboard is not going to solve the problem. A Dell keyboard does not seem to care what my HP is doing. Let's see. Settings, keyboard, devices. Mouse, keyboard, and pen. Kensington, USB Orbit. I got no idea. Damn it. Well, there's an interesting technical issue. I can't even copy and paste this stuff. Let's see if anybody has a comment that's going to help me right now. Pan West. Oh, these are good suggestions. All right, let me see. I'm gonna make a note of it. I can't make a note. Ah, son of a bitch. That's so funny. Hey, you. Can you take a picture for me?
I'm not able to take a picture directly. However, you can take a screenshot or a photo of the screen using your device's camera.
I know.
If you need help.
I know that. These are stocks we've been discussing in the webinar. Please make a note of them as possible investments. So I took a picture and I'm telling them that. And now I'm going to, oh, yeah, he's got it. Not at the moment. Now I want to give you some suggestions. Okay, and now I'm going to take a picture of the suggestions. Sorry about this. Analyze that last picture and add them to the list, please. Can you give us your take on those stocks that were added in the second set?
Got it. We'll take a look at those later. Talk to you soon, Phil.
Analyze the stocks from the second set, please, and give me your opinion.
Sure, let's break down the stocks mentioned in the questions from the webinar. 1. WTI, West Texas Intermediate, short position analysis. WTI, as a benchmark for oil prices, can be volatile. Factors influencing WTI include geopolitical tensions, OPEC decisions, and...
That was not West Texas Intermediate. It was the stock symbol WTI, but skip ahead to the other ones. Not working at the moment. Oh, he did do it. That's funny. All right, so SWKS appears to have good growth potential, the 5G rollout and IoT expansion. It's worth considering for a long-term investment, but keep an eye on the cycles. Enphase, strong growth potential driven by the renewable energy trend, good for long-term investments. PanWest, solid choice. I like PanWest with robust growth prospects. All right, so good. Now we've got them all noted down. And I am sorry, but we will pick this up again next week when we do it again because it's 2:48 already. Oh, it's 2:45. Okay. Anyway, so all I can do right now is just post these because I have no keyboard. And now I have to find a way to charge this freaking thing. And we will have to pick it up next week, okay? So we'll remember where we left off, and we'll do that. And I'm going to start going through these in more detail, and we'll see if we can pick a few for the member chat room, okay, guys? I'm sorry about that. I had not planned on That just did not even occur to me that that thing was, I can't even imagine the last time I had to actually charge that. I mean, I'm talking like years. But anyway, life goes on. Thanks everybody for coming. I appreciate it. And sorry, sorry about that mess. And we'll pick it up again next week. All right. Definitely have lots more stocks to go over. So we'll do it from where we left off. And then, like I said, I'll come up with some trade ideas for these guys and we'll see if we can add them to some of our portfolios. All right. Thanks a lot, guys. Take care, everybody.